All right, everyone, this is part 2 to our discussion of chapter 12. This has to do with business credits. These are credits that a business might be entitled to. Now remember, a credit offsets our tax liability. This is not a deduction. This is a credit for doing certain things. Those credits will then reduce your tax liability. So one of the things that they don't help with is if you don't have tax liability. So that's a part of the problem with a tax credit. These are all non-refundable, by the way. Back to our earlier discussion of back in chapter 2, non-refundable versus refundable. These are all non-refundable. So make things more accessible for disabled folks. You have to be a small business and you have to have fewer employees than 30, okay? And over $250 you spend, like a ramp or some other ability to be accessible to the building, but you can't include anything over $250, and your credit's 50% of that. So you'd have to spend, say if you spent $8,000, your credit would be only $4,000, okay? Substantial rehabilitation. This is when you buy an old house or old structure and you spend a lot of money to fix it up. It has to be a lot of money, okay? It has to be more than $5,000 to fix it up. It has to be more than what your basis was before it. So if you bought a building for $100,000, you got to spend at least another $100,000 in rehabilitation for this to kick in. If you had the property for a while, it would be what you originally paid for it plus any other additions you've already made to it. If it is just old, you get 10% of the amount you spent on it. If it's certified historic, you get the you get the historic structure designation is 20%. So we've got a $100,000 building originally paid in service by 1930. $125,000 restore the structure. You've spent more than $5,000 more than the original cost, okay? And so your credit, because it's not a historic structure, it's just old, is $12,500, 10% of what you spent. And then your basis is only going to be $212. You originally paid for it plus the rehabilitation minus the amount of the credit. So you don't get to count it twice by depreciating this $12,000 because you got a credit for it. So your tax liability, if you had this much tax liability, would be reduced by $12,500. Small employer health premiums. This has become much narrow. This is when you provide health insurance for your employees. Okay, you can only use 2 years, and you have to get the premiums through one of the exchanges, shop marketplace, and it's 50%. And of course, there's a lot of ways of this to be phased out, which makes this one of the more complicated ones. Okay, you have to have 10 or fewer full-time equivalents, and their wages can't be over $26,000 average. If they go over that or you go over more employees, then it reduces how much the credit is. Okay? So if you have 8, you're under, their average wages are $20,000. You spend $60,000 for health insurance because you pay more than half of their costs. All right? Then your credit would be as much as $30,000 if you had that much tax liability. Now we raise the amount of the income for employees, and so for every $1,000 over $26,200, our credit is reduced by 4%. So we're over by 4 times that. So we're going to have to reduce it by 16%. All right. Or $4,800. So we reduced it. Now we're over the FTE. We're back underneath on the average wages. Okay. So we have to reduce it by every person over that by 6.667. Okay, so we're going to reduce it. This credit is 45,000 to start with, reduced by 6,000. So we're now down to 39. Now, if you're over on both of them, you've got to apply both of them. Okay. Childcare facilities, 25% of the expenses, or resource referral expenses. If you don't provide the actual services, but you actually show them where to find it, then those expenses, can have a 10% credit. It's up to 150,000. There's your what qualifies. All right. Take a credit of the startup for establishing a pension plan. Can't have one before, and it's only $500. This is probably one of the bigger ones, and it's complicated enough. We got lots of examples. This is something you don't want to trust yourself to remember. You're going to have to look it up. But certain groups of folks, we give a credit to employers for employing. These are people that are usually considered difficult to employ, and so we're going to offer the employers a credit for putting them on the payroll. Okay? But of course, we're going to have certain criteria and so forth. Here's the 10 groups that are considered this. Now, of course, how do you know this? You generally have to go to a outside party who is going to certify that your employees, as you hire them, fit one of these 10 categories, because you can't ask questions in the job interview about these things. They're illegal. So you have to find another way to know if they qualify, typically after you've hired them, because you can't really know these things before. Maybe except the youth employees, perhaps, but the others, you're not going to be able to know what that is going in. Okay, so your credit can be 40% or 25%, depending on the hours of 6,000. So this is first year wages up to 6,000. 40% if they work at least 400 hours, and only 25% if they work between 120 and 399. If they work less than 120 hours, you don't get anything. Okay, so they fit in the category. Their first year wage is 8,000, 650 hours, so we're over the 400. So we're at 40%. We can only consider 6,000 maximum wages. Take 40% of that, get 2,400. This person only worked 250 hours. They qualify. First year wages is 5,000. We're going to take 25% of the 5,000 because that's less than the 6,000 that you could go up to. 6,000 is a maximum, not a minimum. Okay, so we're going to get 1,250. So a little bit about summer youth employees. All right. So again, that's how many hours, and their 3,000 wages is all that they can for summer for these kids. All right. So 3,000 times 25%. Qualified veterans, 40%. And then there's different categories of veterans. Unemployed veterans, those that have disabilities, those receiving food stamps. Okay? If they're unemployed for longer, then the maximum could be higher. So if they've been unemployed for at least 6 months, instead of 6,000 first year wages you could consider for the credit, it's 14,000. See how much difference that makes. Okay, if it's 4 weeks but up to less than 6 months, we're back down to the 6,000. Doesn't count if they don't count it as a return hero without being at least 4 weeks out of work. Service-related disabilities, notice that unemployed up to 6 months, they were clear up to 24,000 that for it to be considered. And less than 6 months, 12,000. So a higher rate there, okay? And no minimum 4 week unemployed, okay? food stamps. All right. 8 months, wages were paid $20,000. Did not have a disability, so you're taking $14,000 maximum times the 40%. You only count the first 14, even though he was paid 20. So right, because there's this maximum. If there was service-related disability, okay, then you could count all 20,000 and multiply by the 40%. So there's another example. Only employed for 3 weeks, so they do not, and they don't have a disability, so it's 0. If they had disability, you could, even though they were only unemployed for 3 weeks, it would still be 40%. So, lots of different combinations and such that you're just going to have to look up. Now, the other thing that you have to think about, this credit, if you take a credit for wages paid to an individual, you cannot deduct that as an expense for the amount of the credit. So you have to reduce your wage expense by that same amount. The other thing you have to worry about is when the first year, this is all based on first year wages. Well, what if they start working June 1st? Their first year would be all the way till the next May. But some of that would be in 1 year and some of it could be in the other. So you could have it spanning 2 years. So you have to keep track of these employees for 2 years sometimes, unless they happen to exactly be hired on January 1. All right, or you reach your maximum already. So we have someone who qualified, first year wages were $4,500 in 1 year, the rest of it paid the next year, but still within the first year that they were working. Okay, so for 2018 it's $4,500 times 4%, 40%. You can only go up to a maximum of $6,000, so it's the second year, you're only going to do the $1,500 times 40%. Okay, the difference between the maximum and how much you've already used the year before. Okay, so a couple of examples this way, and 3,000 already used. Okay, other 2,500 in the second year. For the last category, you can use 2 years, first year wages, and then lesser amount or greater amount in the second year to try to keep them employed longer. Okay. So first year 40%, and then second year 50%. This is a investment in usually a depressed area in a city or something that's determined as a new market credit, and you get a credit for that as well, 5%, and increases for later years. But like all these credits, it reduces your investment or your amount of risk or your amount that you can count towards that in all other ways. All right. So those are the tax credits for business decisions. All right. That should cover, finished up chapter 12.